All right. We're going to give it a couple more minutes before we begin. There's always a few stragglers. If you're attending from Arizona, it could be a little bit wet. That's why I like these Zoom things, is because no one has to worry about traffic getting here. Um, just have to find where the link is and you can get right on board.
There you go. Great
Exactly.
plan. Great, great point.
We'll give it another 1 minute because I don't like to start these too late. I like to be responsible for everybody who shows up on time. Bill will be letting people in as they come because we do have the waiting room turned on.
Okay.
And all right. So just excited. I should be playing music and dancing, getting myself all jumped up. But I actually really like teaching about taxes and life that happens around it. So it's kind of important to me. So why don't I get started here? And if people come late, they come late. Sorry, I'm trying to hit the share button and I'm doing the wrong one here. All right. So good morning, good afternoon, wherever you are. My name is Sharon Lewis, and I am a tax professional. I am an enrolled agent. I have a background in accounting, and I have studied taxes for the last 24 years. And one of the things that I really get frustrated with is when people come in and are filing for divorce or have filed for divorce, and then they're upset about the taxes or what happens when divorce goes bad and where the messes take place. And I really thought it was important to educate people on what decisions to make before the the divorce happens or during the divorcing phase so that there's not the surprise when it comes to filing tax returns. So I don't know if you're in the process of getting a divorce. This is actually designed more towards business owners, but if you just know someone who's getting a divorce, this would be a great video or education piece for them, especially if they have, houses or retirement plans or just, mutual and family tax debt, just stuff like that will affects everybody. So let me go through this. Um, First, when marriage ends, the IRS still wants their share. And they literally don't care which of the parties, if the debt took place before the marriage happened, they don't care which party it comes from. And so,
I had no idea you were there, Bo.
as it is, divorce already causes emotions. Your people, emotions don't end with the filing of the divorce paperwork. Um, you are no longer emotionally committed to this person, but you still have taxes or could still have tax compliance issues to deal with. The IRS doesn't separate the liability in divorce. He made more money, so he's supposed to get it. Even if the divorce decree says that, that is not how the IRS sees it. So there has to be some different rules that set up, and you need to know about those things. Then the other IRS doesn't care who started it. They only care who signed the tax returns. So if somebody has filed a tax return and it was supposed to be married filing jointly and both spouses don't sign, that is actually a criminal activity and that needs to be handled a different way. So there are different things that we look at when divorce takes place or when people have a tax issue related to the divorce. So let's just talk about the three types of divorces. Okay. First is the friendly divorce. Everybody's cooperative with each other. He agrees to give her, or she agrees to give him part of the retirement plan or part of or give them the house or whatever. Then we also have the evil divorce, okay? There's deception, there's manipulation. Whichever spouse has the most assets or earns the most might be hiding assets. They might be moving money. There might be, I heard of one case where the guy actually had gold hidden in a floor safe in the house, and the ex-wife wasn't getting what she wanted in the divorce. So she told the IRS where the gold was. And the IRS came in and actually arrested him because he actually owed, over a couple $100,000 in taxes and was claiming he was broke. And so she was upset because he wasn't giving her what she thought was her fair share. And he ended up going to prison for, hiding funds, not only from her, but from the IRS. And then evil meets evil. One person does something, and then there's, one person does revenge, there's chaos, there's tax fallout. And I have seen all three of these cases in 24 years of doing taxes. And so how you go in to the divorce, or what you're met with in the divorce, is actually something that we actually have to take into account while we're doing the taxes the year or the couple of years afterwards. I've seen a friendly divorce where everybody agreed to everything. The assets were split, and then the next year the husband claims both of the kids, even though the divorce decree said something different. So you can go in with, look, we're cooperative, and then things don't go the way it's supposed to, and then there are problems because of how this is. And there are ways to actually talk about preventing this so that these things don't happen while you're in this process, or the year or two afterwards, so that there's cooperation in the divorce. So let's talk about this. Number one is joint tax returns. So if you're married filing jointly, so maybe you have split up but you're still married throughout all of 2025, let's say, and you opt to file married filing jointly, you are still responsible for the joint tax. So it might not be in one spouse's best interest to file jointly with that person if they wouldn't be getting as much, if there's a tax balance due. And so that's one of the things to look at and actually discuss with the person preparing your taxes, or with the attorney, as to who the tax liability belongs to or what needs to happen. The divorce decree does not protect you. The divorce decree is a state document. It is filed with the state that you reside in, and the state determines, the judge in the state determines how assets are going to be split. But the IRS doesn't care. So if your tax decree or your tax return says you jointly owe $75,000, and the former spouse is supposed to be paying that $75,000, and then they don't, the IRS will take your tax return to pay, or your tax refund to pay part of that $75,000. So you could go for 2, 3, 5 years, whatever it is, be paying that back taxes because that prior spouse is not paying those tax returns. In fact, the IRS could garnish your wages or levy your bank accounts, and you're stuck paying for tax liability that your prior spouse didn't didn't pay, even though they were supposed to. Now, there are things called innocent spouse and injured spouse. And these are one of the things that we look at in divorce situations where things are kind of messy. One is an innocent spouse, where you're innocent, or a spouse is innocent of the tax debt that's there. And I'll give you an example. A spouse is a self-employed real estate agent, doesn't pay any self-employment taxes. So the taxes owed are part income tax, which, let's just say that's about $10,000, and then part self-employment tax, and we'll say that that's $25,000. When the return is filed, you're both on the hook for $35,000. Well, you can turn around and say that self-employment tax actually belongs to my former spouse, and I'm not responsible for that. I'm only responsible for half that tax. The problem is you guys don't normally know how to how to apply these forms when they apply, or whether or not the IRS will consider them. The other thing is an injured spouse, and this we normally see with people who have remarried. Maybe your spouse owes back child support or has back due tax debt from their marriage, and the IRS wants to take your entire refund to apply that. You can turn around and say, that's not my debt, and I want my share of the refund. Now, there are times when you want to do that and times when you don't, and that's definitely something to discuss with, again, your tax professional. But it's a way where you don't have to pay someone else's tax debt. And so those are the things that we look for as tax professionals when we're working with people who have actually suffered a divorce. So give you an example, I have my story here. This is the secret child. So client comes to me, they're trying to get an innocent spouse. She's beside herself. He is a high wage earner sales rep for a company. She's been a stay-home mom with 4 kids, and she's now gone back out into the workforce because of the divorce proceedings. And during the prior couple of years, he'd been having an affair. His affair partner gets pregnant and has a child. So what he does is he stops taking out withholdings and now pays the girlfriend child support, which was in lieu of his tax withholdings. So this is how the wife actually finds out what's going on, is they sit down and they go to do their taxes, and this was probably 15 years ago is when this case came into our office. He makes, say, $150,000, and the withholdings this year, and they're used to, because they have 4 kids at home, they're used to getting a refund. Well, this particular year, they owe $8,000. And she's sitting here going, how do we owe $8,000? And why do you have no withholdings? And you're only bringing home the same amount. And he turns around and confesses that that additional money that was in the withholdings is going to the affair child's, and so that causes a collapse of the marriage. And so she is on the hook for those. We don't get to give her an innocent spouse or an injured spouse because of how the IRS reviewed that entire case. And so she ended up, even though the IRS, even though the divorce decree said that she wasn't supposed to pay this, he was, because he had done this to her, and he was using marital assets to pay for, this additional child. It ended up being her tax refunds for the next few years actually paid the joint marital taxes. And at that point in time, she was just so frustrated, she was willing to do that. Now, I don't know if I would have been willing to do that, but she just wanted to move on with her life and what have you. So it's really important to, if you are thinking bizarre things are going on in your marriage, you might want to look for, paycheck stubs and things like that to see what's going on and how your spouse is acting. The next situation is my gambler. Okay. This woman thinks that she and her husband, he's hanging out at the bar too often. She's not happy. Their marriage is falling apart, and she files for divorce. They file their tax returns, married filing jointly. And maybe the divorce wasn't even filed until after April. So they go through, they file their tax returns. She files for divorce in May. In October, November, she gets a letter from the IRS saying, you guys owe additional taxes on $100,000. She has no idea why. It turns out her husband was a compulsive gambler, was hanging out at a bar that did sports betting, and he was winning and losing money at the same time. And she's now jointly liable for those taxes because of the way the tax return was filed. So there was a way, we click back over here, where we talk about innocent spouse. There was a way to apply for innocent spouse because it was hidden income, and that she was able to actually get out of most of that tax debt related to that gambling. But it's really important, if you think something is going on fishy with your spouse, pull transcripts. If you think that there are stock sales that you don't know about, pull transcripts. You can go to the IRS, your attorney can go to the IRS and request copies of the transcripts. That might be something that is part of your negotiation during the divorce process, that you want a copy of the transcripts for the last couple of years to make sure everything is on the up and up. Because these particular things come back and haunt people and cause, thousands of dollars being paid to an expert to be able to get and negotiate out of tax debt that actually shouldn't have been awarded to or charged against a particular spouse. So these are things to keep in mind. The same thing happens with business income. If a spouse is making money through their business and hiding it from the spouse, it goes under the same category as the gambling winnings. It's hidden income that's never seen the benefit of the family. And so these are things to look at and to make sure that there's a workaround for it. All right. So let's talk about, this is going to get into, now these people were just naive in their divorce filing. They weren't, their spouses didn't intentionally, weren't manipulative as far as doing things during the divorce. These are just things that caused the divorce and led them to tax debt during or after the divorce. Now we're going to talk about the disasters that we've seen. This one particular here, Sally's a school teacher, works here in Arizona, makes, what Arizona teachers makes, $50,000, $60,000 a year. But her husband was an executive in the real estate industry. They were always investing in rental properties. And because his income fluctuated depending on the market, most of the mortgages were in her name, tied to these properties. When they went through the divorce, the property was appointed to her husband as part of the asset settlement, but the mortgages were in her name. So the problem is the mortgages are in her name. The IRS rules that the income and expenses belong to her, but he got them. And so this is a problem that not all divorce attorneys take into account. And you need to look at what loans, whether they're business loans tied to a specific business or a business investment property like this is, what the situation was. He was, part of the divorce decree was that he was supposed to be paying the property taxes on, or the property mortgages and the taxes on these properties. And because they were mostly in her name and he was not refinancing them out, she actually had to take him back to court and have the assets moved over because the judge called him in default of the divorce decree and actually reverted the properties over. He did some other really malicious things during the divorce process. Every year when we did her taxes, it was like, all right, tell us what the story is now. And they had a very contentious divorce for at least 3 to 4 years that she was with our firm, as far as the situation with them. So the lesson to learn from this is if you have investments, make sure, and there are investments that have financials on them, make sure that those align with the divorce decree. The mortgage and the property goes to the one person, or there's a specific timeline for the refinancing. And then make sure you're checking the credit report. If it's in your name during the marriage and they're supposed to refinance it, maybe they can't because their wages aren't high enough or their credit score is not high enough and they're keeping you on it. Make sure they're making the payment on time on that so that your credit is protected. Because I've seen cases where a spouse was awarded the property and they're not making the mortgage payment. And that's one of the things that Sally's ex-husband did is he turned around when because all the tenants knew him because he had handled all the property because that was his professional industry. He actually went and collected the rents after the property was turned over to her and then stole the money. What we did as a firm is we issued him a 1099 for those additional funds that he stole, but it left her, when you have, 3 kids at home, a limited salary, and now you're making a mortgage payment on both your current home or rent on your current home, and then paying the mortgage on a property you're not living in, it causes financial hardship. So that's really important to make sure that all of that aligns correctly. And these are the pieces that not everybody thinks about. And divorce attorneys, they're interested in separating the assets and making sure that things are labeled fairly. But the IRS and the state do not align with each other. And it's important that you have the right protections in place during the divorce process to make sure that everybody knows who's going to be stuck with what taxes and how are those taxes going to be paid, and making sure that it's equitable, or how is that going to work out. To give you an example, one of our clients, her husband, when they got divorced, he was self-employed and wasn't paying any taxes. And when they separated, she had a high-paying job, had stock options from her employer, and he decided to quit working. So she just turned around and said, you know what, I will just pay the taxes for him because he's, my kids are going to get stuck supporting him when he's older. I just want out of this as quickly as possible. And so she just stepped up to the plate and did that. But that doesn't always happen. Sometimes people don't have those assets to be able to make those decisions. And then it ends up being a financial hardship. And that's one of the things that we often see. All right, let's talk about Jason. One of the things that we want to talk about is actually marital debt. So a lot of times in marriages, people will use credit cards, and we're of the belief that if you're using credit cards, you should be paying them off, monthly or within a short period of time and not carrying balances. The problem becomes a lot of people carry balances, and sometimes that is actually the reason for the divorce is there's a spouse with a spending problem. So during this particular case, I'm going to use the name Jason. Jason decided that part of the divorce was that he was going to pay off all the marital debt. That was what was assigned to him in the court. And so he decided to pull that money out of his retirement plan. Okay. He withdrew the $100,000 from the retirement plan. And he paid off the tax debt that was owed, whether it was 100,000, I'm not sorry, the tax debt, the credit card debt that was owed, whether it was 100,000, whether it was 75,000 with 25 going to help him set up his new place. I have no idea. However, the problem is Jason was under the age of 59 and a half. And so him pulling the $100,000 out of the retirement led to two taxes. Okay. There's a penalty on that, which is 10% of the taxes. And then there are regular income tax on that, which ended up being $31,896 based on what his income was. So he ended up, and then an additional $4,000 to Arizona. Well, so he pulls out 100,000, he pays off all the marital debt, and now he comes to me in April, for, at least 4 to 5 months after the divorce. And now he's pissed because he's got to come up with an additional $35,000 to pay taxes. So by paying off the marital debt, he screwed himself out of an additional $35,000. So it didn't cost him $100,000. It cost him $135,000 to pay off all the marital debt because of the taxes and penalties. That was never considered during the divorce process. The assets that were split, any of that was not considered. And so he was furious. I remember it was not a good situation. He was absolutely furious. 46% of his funds are gone, and he's got nothing to show for it. And his ex is walking away without any debt, and he's gotten stuck with all the taxes. So paying off marital debt through retirement plans is not the way to do it. There are ways to actually do it so that it becomes fair. Our recommendation, to give you an example, our recommendation is that $50,000 gets transferred to the spouse's into the spouse's name through the retirement plan company, and $50,000 Jason withdraws, and the ex-spouse withdraws her $50,000, and then a title company, a neutral third party, is used to pay off all that debt. Then both of them will split the taxes and the penalties. So then Jason doesn't get stuck with the full $31,000 or $35,000 in taxes. He gets, if he only withdraws $50,000, he only has $5,000 in penalty, and then he ends up with probably a third of these taxes that are actually on that sheet there. So there are strategies that we can use to minimize the taxes. Sorry, I thought I turned my ringer off. To make it so that it becomes fair and equitable for everybody. Sometimes if your name's not on that credit card, do not pay off the marital debt. That might be part of the negotiation. The attorneys might have to work a little bit harder to actually take care of this. So we want to, when we do these interviews with people, we want to ask them a lot of questions to make sure that the decisions that they're making are decisions that are not going to affect them, into the future, and hurt them later on. There's also things that we can do where you can actually take money from a retirement and transfer it over at a later date if there's pensions or different retirements that allow for that to be transferred over tax deferred, so that you're not withdrawing that because one spouse has more money in retirement and the other one doesn't. All right. Next is another bad choice. So this was actually a personal friend of mine who did not come to me during the process of the divorce. I found out about everything that was going on a year and a half later. I knew she was getting a divorce, but I didn't know any of the backstory of it. We weren't that close. And then she came to me for tax advice 2 years afterwards. And I just sat there shaking my head going, I really wish you would have talked to me during the process. Excuse me one second. So, not a real name. Ariel works for Costco. Has worked there for a long time. Has a great retirement plan. I'm making up the same company. I'm making up a company too. Has a great retirement plan. Works for them, and she buys a house near the place that she works at. And then she gets married, and they have a kid. So the house is in her name, and she has a retirement, and soon-to-be ex-husband doesn't have any of these things. So she decides, in order to not have to give him her retirement, she's going to give him the equity of her house. Okay. So it looks like a simple fix, right? I'm going to sell the house. He gets half the equity or 3/4, whatever the attorneys, have determined is the equitable there. And then because we live in a community property state, that was what was deemed part of it. So she does that. A year later, she comes and says, I'm going to buy a house, and comes to me and says, or 2 years later, I'm going to buy a house. I need to pull money out of my retirement. Well, what she would have been smarter to do is actually transfer that money from the retirement plan to him based on the amount that they had determined was equitable. And then she had kept the cash from the house because she's reusing it. Instead, she actually goes back to almost the same lesson as Jason there. She pulls out $45,000, 30 something of it was for the down payment on the house, and 15,000 of it was for taxes and penalties because, again, she was under 59 and a half. So what the dollar cost, what she had pre-tax versus post-tax is not the same. And that's the problem, is the equity doesn't end up being split evenly. One partner actually takes more of a tax hit, which isn't, which it doesn't create the equitable effect that is supposed to be happening. And those things aren't being considered during the divorce process. So these are all things to keep in mind. Is we look at how things are structured financially. And then how do we structure like businesses when we do this? What becomes fair and equitable? Does somebody having a 20% ownership interest in a business? Those are all the different things that we look at that are not actually considered as part of the divorcing process, but are considered about the back end financial process. And so most people don't realize that these things need to go, or they should go hand in hand, because when they don't, one person ends up paying more in taxes than the other, and it ends up hurting. I'm just finishing my college degree, okay? So I'm working to get experience. My very first job in the accounting profession, I'm working as a accounts payable clerk, where it's a civil engineering firm, and the partners is the partners in the firm, one of them's getting a divorce from his wife. So in order to reduce the amount of alimony, he literally is torching his company. They are underbidding on projects. They're having cash flow problems. He's doing anything he can to damage his business to avoid paying out his spouse a quarter of the business equity. And that right there, that sabotages and triggers audits within the IRS as to why things are happening. On top of that, they actually, because they're a civil engineering firm, they did state and city work, which means there's different bonds. Well, it ended up causing problems with their bonding organization, and the business ended up tanking within 5 years. Well, the worst part about it is he still ended up having to have to pay his ex-wife alimony for however long because of the asset split, but he's caused irreparable damage to his business. So thinking these through and working with a coach to help decide how's the best way to structure an equity payout. Is it to structure that she gets alimony, monthly payouts for the rest of her, for whatever the time frame is, or does she get the owner has to put money into a retirement plan on her behalf for future, so that you're not damaging the business and causing irreparable harm to a business. What ended up happening to them is they lost their business. And it was a horrible thing to see that, people who'd been working for this company a long time, ended up losing their jobs because one guy didn't want to pay his soon-to-be ex-wife, whatever the courts had determined. I've also seen it's very important to, if you are going to do a divorce and you have a own a business, that you actually get a third party valuator in there, because the third party valuator will look at things differently than attorneys do. I've seen a construction company in the past where they took on a $200,000 house remodel, and that $200,000 was considered income, when in fact that was actually money to pay for, remodeling expenses. And so that again caused the company to crash because a valuation wasn't done, and they looked at the gross revenue instead of the net income, and it ended up hurting the business owner. So having the right professionals involved during a divorce when you have a business ownership is super important. All right. Retaliation and financial sabotage. So the ex refuses to pay the debt, steals the rent, or gets intentionally fired. I have seen all of those, where, one party is actually stuck paying tax debt or credit card debt. We always recommend that if you're on any credit card or have any credit card, and you know that you're in the process of getting a divorce, the first thing you do is close those accounts so nobody can rack those up. One of my good friends, she had paid, they never carried debt. She had figured out that she needed to create an exit plan. Her husband was becoming physically abusive, not just to her, but now to their child. She talks him into buying a house near both of their families so they don't have to stay in a hotel, and then she packs up and moves into there. He finds all the credit cards in the filing cabinet and charges them up within 30 days. So they've gone from having zero debt to basically $30,000-$40,000 worth of debt. And now she is a single mom paying a mortgage on a place that she's living in, and is struggling with being able to pay all the credit card debt that they had jointly that was all of his. And it ended up causing her to file bankruptcy. So the minute you know that you're going to be leaving, it's time to cancel the credit cards. Get your name off of them, whatever you need to do that. The Sally incident that I told you about, her husband went and told all the tenants that in the properties, even the properties that she was awarded, that they need to pay the rent. And he gave them a letter that says all your rents need to be paid to me or into this particular account. And she didn't have the money to pay. And they actually literally had 6 rentals. So she's trying to come up with money and having to have to borrow money from her family in order to not have to lose these properties or have her credit hit with all of this. Again, it takes a court action to get him to stop doing this. So that again costs money. So having a clearer split of who gets what property and who gets what loans and how things are handled needs to be considered during divorce processes. The other one is guy's another one, high wage earner. He turns around, doesn't like the amount of alimony and child support that he's required to pay, and he intentionally gets fired. He intentionally gets fired. Well, she's sitting there trying to support the kids on her salary, and the IRS is taking her tax refund every year because of the mutual tax debt from his high wage earning job that they had during the year. So that didn't help her out. We were able to actually get her onto what's known as currently non-collectible and negotiated with the IRS to say, look, and then we adjusted things so that she wasn't giving the IRS any extra money. And then again, attorneys are involved to have him, go back and get a job that, and I don't remember what happened in that case. I just know that the consequences really, was a struggle for her. The good news is she had family support, but that's not available for everybody. So lesson, revenge creates tax fallout. And it could be a tax fallout that lasts for 5 to 7 years after a divorce takes place. So keeping that in mind, it might even go up to 10 years, depending on what strategies former spouses do. It's not pretty. It creates a lot of havoc. So, all right. So let's talk about. I like this one. I call this one dumb things taxpayers do. Number one is 401k withdrawals. Okay. Mario makes $600,000 a year. He's a fantastic professional salesperson in an industry that pays really, really well. Wife has been just working, $40,000 a year job, staying home with the kids. They decide to get a divorce. Part of the divorce is because he's got such a great income, is that he has to give her part of the retirement plan. Well, he contacts Fidelity, who manages his company's retirement plan, and they tell him to just withdraw the $300,000 from his retirement to pay her the retirement. That he called me and says, Sharon, this just does not sound right. And I actually was like, do not do this. Do not. You need to go back and talk to a supervisor and keep asking for a supervisor until you get somebody who will talk to you about something called a quadro. That's what we call it in our industry. This is what the abbreviation is. Google it. I can't remember what it's called for, but it's a qualified distribution retirement something or other. And what that does is, let's say that Mario's retirement was $500,000 that he had. Mario had to transfer $250,000 to his soon-to-be ex-wife, and so we did the quadro split. It transferred $250,000 into her name, and then if she needed that money to buy a house or do anything, she would pay the taxes on it. If there was stuff that she needed to do, it's her money now to do whatever she wants. If she wants to save it for her retirement, great. If she needs it for something else, that's great. But he is no longer responsible for the taxes on it. So don't withdraw the money. Ask to have it in a quadro and make sure your financial advising firm knows what to do. The other thing is, don't file jointly out of guilt. Well, we've always filed jointly. You want to look and see if it's in the best interest of both parties. It might not be, especially if one person has been paying taxes all along and the other one isn't. just because you've been married in the past to somebody who has bad tax or bad savings does not mean, tax savings responsibilities does not mean you need to file jointly with them. It will bite you in the butt. Um, it will bite you in the butt. The next is trusting an ex to handle the taxes. Um, we have a new client that came in the other day, and he's been waiting for his wife to file their taxes for the last 5 years. It's 5 years they haven't filed. 5 years. Um, the sad news, she actually did file hers as married filing separately. And so she took all the kids, the house, all of that, and left him with nothing. And they have been living apart, not divorced, and or living I can't remember, maybe they're living together. But she did it so it's married filing separately, and he's going to get stuck with a big tax bill. And so we're in the process of doing the last 5 years for him. And he just found out. So we get to see him coming in here emotionally devastated that not only, I think he was happy about the divorce portion, but he's not happy because she has left him in a terrible situation. And he waited thinking that they were doing things together because that was part of their conversation in their divorce. And it wasn't done that way. The other thing is be really, really careful. Your spouse, if they are likely to create fake deductions. We have seen people come in here and saying, well, I get to deduct this and I get to deduct that, and this is this and this is that, to try and lower the amount of taxes that they have. And that is a problem, because if you get caught doing that, the penalties are larger. You could also be arrested for fraud if it's, if it's more than a mistake and the IRS can tell it's more than a mistake, they can actually look at prosecuting you for that. So we don't recommend people doing that in order to avoid some of their taxes. This, I think, is funny. This is part of my notes. When to fire bad clients. If I know a spouse is lying or cheating, we actually will fire them. We're really big on our firm ethics, because I don't want to be dancing with the IRS on things that I know I can't lose because I know somebody did something illegal, or I can't do anything about the immoral stuff, but I know I can't outsmart the IRS. So if somebody comes to us and they're not what we, who we want to work with because of the choices that they're making, we will actually, one of those cases in there, we actually did fire because he was making up deductions. And we were like, no, you're not a good fit for us. Didn't care that I'd already done the tax return. When I gave him the tax return and told him what the balance was, and he was upset about it, he came back with a whole bunch of other deductions. And I'm like, no, doesn't work that way. Just you need to go away. Because I don't want the tarnishment, and if I know something's illegal, I'm technically not allowed to file it, and so is my staff. So protecting yourself before, during, and after divorce. Number one, we want to review 3 years of your tax returns. Number two, pull IRS transcripts. Know what each person in the family has done, what the incomes are. Make sure that you document your finances. If you're getting ready to divorce, you want to know where the bank accounts are, all the bank accounts. You want to know where the credit cards are, all the credit cards. You want to know what your name's assigned to. Pull a copy of your credit report. Review these things and make sure you have your ducks in a row. One of the women I worked with before, before I finished my accounting degree, I was one of these people who got my associates and then came back and figured out what I wanted to do. So I was working in the mortgage business, and one of the young ladies, she was getting a divorce, and she had talked to her parents about it, and they were trying to discourage her from divorcing her husband. And she says, Mom, Dad, he's good to our son, but he is terrible to me. And before she had documented anything, she had just said to her husband, I don't want to be married to you anymore. He literally took her name off of all the bank accounts, moved money into other accounts that he didn't have, pulled he had a lot of money in savings and stuff like that, pulled those, and because he was literally from another country, he moved some of his money back to the home country. So now there's no US jurisdiction. And she ended up, oh, and then they had a lot of jewelry that was either inherited jewelry or I can't remember if that's the industry he worked in, so there was always jewelry around, but all the jewelry was gone. Everything that he had given to her, he had taken. So make sure you get your ducks in a row first, and that you have you have these things documented. You don't have to go sneak and take the jewelry or anything like that. Take photos of it and date. These are this is the date. Have a witness that was with you when you take the photo. All of our phones, all of our cameras have phones. All of our phones have cameras on them. Take a picture of the jewelry and saying, this is what we had on this day. If he's gotten rid of it, or she's gotten rid of it, that needs to be accounted for in the divorce settlement. One of the things that we do offer here is a divorce tax checkup. It is $9.97. We review the last 3 years of returns. We will pull your transcripts. We will look at your divorce terms. That particular offer is available. The other thing that we're doing for businesses and individuals, and this has nothing to do with divorce whatsoever, this just has to do with tax planning for the rest of the year, is we are actually offering through December 2nd, because we're so close to the end of the year, we have to have enough time to get them all done, is an individual tax return review. And what that is, it's a tax plan. I'm sorry, not a tax return. It's to figure out where you're at, if you're paying enough in taxes right now, or what we anticipate your taxes being for 2025. So that there's no surprise. If you're an individual filing a 1040 return, it's $497. If you're a business or an individual, so you have a S Corp, an S Corp, a partnership, an LLC, a C Corp, any of those, it's $897, and we'll review both the business and the individuals. And you need to sign up for that before December 2nd. If you'd like to attend more of our webinars, or you would like to find out about either one of those, you can go ahead and contact us at our website. Our website is right here. This is not the email that's supposed to be on here. I don't know what happened here. Either contact us at Sharon at lbstax.com or admin@lbstax.com. Remember, divorce is emotional. Taxes are mathematical. So the IRS doesn't necessarily care what the emotion is or who did what. They want to know what portion is theirs and how they're going to collect it. So that is pretty much my presentation on divorce and taxes. If you're going through this, or if this is something you can use for a client, I'm more than happy to help out. Are there any questions? All right. Well, thank you for being in attendance today. We appreciate you, and have a blessed day.